Hi, I'm attorney John Mitchell in Houston, Texas, and I specialize in federal IRS income tax matters. Now, this video today is about some of the top 10 highlights for personal returns that you might find interesting from the new tax law that was approved by Congress in December 2017. Okay, so under the first thing that I'm going to talk about is tax brackets. Okay, each tax bracket has a minimum and a maximum amount of income that makes you fall within that tax bracket, and whatever the percentage rate is, that's your marginal rate. Okay, so the current law, or the law up until December 31st, 2017, there were 7 tax brackets going from 10, 15, 25, 28, 33, 35, and a top bracket of 39.6%. Under the 2017 law, the tax bracket at 10%, the threshold was 9,325, and the top bracket starts at 418,400. Under the new law, the tax brackets, there are still 7 different levels, okay, but they are 10, 12, 22, 24, 32, 35, and 37%. And they've also changed the cutoff points of these brackets. So the percentages change and the cutoff points change. So the 10% bracket is up to 9,525. So it went up a couple of $100. But the 37%, which is the new top bracket, starts now at $500,000. Okay, so next up on the list is AMT, the alternative minimum tax. Under the old law, a single person didn't have to worry about paying AMT, did not become liable for the alternative minimum tax until $54,300. That was the threshold. After 54,300, now you're liable as a single person for AMT. And now under the new law, beginning January 1st, 2018, so whatever money you make for 2018, when you get ready to do the 2019 tax return, that's when this is going to kick in. The new maximum is 70,300. So fewer people will be liable to report and pay AMT. As a married couple, it's going up from 84,500 to 109,400. Sorry to keep looking down, but I have to look at my notes and be sure I give the right numbers on all of this stuff. So long story short, single person 54,000 jumps up to 84,000, and for no. 54 to 70, and then a married couple goes up from 84,000 to 109,400. Okay, and AMT, alternative minimum tax, does go away under the new law for corporations. So this is just individual tax returns that we're talking about here. Okay, number 3 on the list is the good old standard deduction. So if you know anything about personal taxes in the United States, you know that you fill out your 1040 form or a version, the variation thereof, and you have to either itemize or take a standard deduction to calculate your taxable income, right? So under the 2017 law, a single person had a standard deduction of 6,350, and a married couple was able to deduct as a standard deduction 12,700. So that means whatever money you made on your W-2, right, or however you made money, whatever money you made, you deduct that amount as part of calculating your taxable income, right? So you don't pay taxes on your first 6,350 as a single person, or on your first 12,700 as a married. Now that is going way up. 2018, as of January 1st, 2018. The single person standard deduction will be $12,000, and a married couple goes up to 24,000. And you say, oh, that's great, but something's going away and it's changed for that, and that is the personal exemption, which 2017, the personal exemption was $4,050, and as of 2018, that is going to now be completely eliminated, which means a household that has more people, living in it, more kids, might end up taking a hit on that because they're not going to get a $4,000 exemption per person. They're just going to get the standard deduction. Okay, so local tax, also they call it sometimes in the paper SALT, so that's state and local tax. And here we're talking about property tax, sales tax, and income tax levied at the state and local levels. That was fully deductible, and now it is going to be only deductible up to a $10,000 limit. So that's mostly going to affect people in high tax states, maybe New York, California, comes to mind. So that's not going to affect most people, and a lot of people who even deduct don't have $10,000 in local taxes, but it is what it is. So that's the new limit, $10,000 on state and local taxes. Once again, we're talking about property, sales tax, income tax, right? Okay, now out-of-pocket medical expenses, that's number 6 on the list. For 2017 and 2018, they've lowered the floor for that from 10% to 7.5%. So we are now, as I record this, in 2018. So if you are going to, let's say, get a LASIK surgery or braces or whatever you're going to do, if you deduct and you're intended to do some of that stuff, well, maybe now is the time to go ahead and get that done, right? Because it's a little bit favorable. Instead of taking out only deducting over 10% of your AGI, it's going to be 7.5%. Be a little bit favorable for you. Okay, number 7 on the list, we got mortgage interest, and so the current maximum is $1 million, and that's going down to $750,000 as of January 1st, 2018, and that is not $1 million worth of interest. That's interest on a loan up to $1 million. So if you have $1 million mortgage on your house, first and second, then all of that interest is deductible. Over $1 million worth of mortgage, then you lose the interest deductibility over that threshold, right? And that is now going down to $750,000, but it is not going to affect mortgages that are already in effect right now as of January 1st, 2018. Only new mortgage originations as of the first of the year. Okay, and it's now not going to apply to a home equity line of credit. So no more deductions on your interest on HELOCs. Okay, let's see. Number 8, we got the child tax credit. Currently, that's $1,000. They've bumped it up to $2,000 for children under 17, and they've gone ahead and made $1,400 of that refundable. Okay. Number 9, we've got estate tax. Currently, you can leave, if you're a single person, $5.5 million in your estate to your heirs, tax-free, and that's going up to $11 million, which means a married couple starting January 1st, 2018, can now leave $11 million an individual, and married filing joint can leave $22 million, to their heirs, tax-free. So the estate tax will not kick in until over those thresholds. $11 million for a person, individual, $22 million for a married filing joint. Okay. Number 10, the very last thing on my list is the things that are not changing. Student loan interest, they had mentioned that might go away, but that is still going to be deductible. Medical expenses, they had at one point proposed doing away with those, but medical expenses are staying with us. They're still going to be deductible. And one other big thing that they had thought about changing were retirement accounts. Thankfully, they did not do anything at all in that regard. So whatever you were going to contribute to your 401k, you can still do the same amount. So that has not changed at all. So once again, if you need, I'm going to try and make a PDF of this. If you're interested in that, I'll try and put a link in the comments below. Or if you don't see it, just email me, attorneyjohnmitchell@gmail.com, attorneyjohnmitchell@gmail.com, and I will try and shoot you that PDF. And if you need to talk about your particular tax situation, please go ahead and give us a call. Our number is Houston, Texas, 832-668-5393. or you can shoot me an email and we'll be glad to give you an appointment. You can take care of your tax matters in person with us. Thanks again for watching, and don't forget to like and subscribe, and contact us if you need more personalized information.